Hello everyone and welcome to the second part of the webinar Multidimensional Trading. It is the second part in a series of two webinars dedicated to combining different time frames together to analyzing holistic view, big picture perspective and making better decisions eventually in our trading. It might not be necessarily long-term trading, might be short-term trading. My name is Stanislav Bernhoff and I'm a trader with over 11 years of experience in Forex, futures, CFDs and options. I'm going to share with you some interesting information concerning trading. This webinar is being recorded, and for those who are watching this webinar in recording, you can ask all of your questions in comments. I will do my best to give you a good answer. Please be specific to receive a good answer. Alright, and before we start, traditionally let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial and you accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are ready to start. And I want you to remind of two concepts or two approaches for analyzing different time frames. First, there is a multi-screen analysis, which is charting approach. So we combine different charts together. For example, it's weekly, daily, 4-hour chart, 30-minute chart, and 5-minute chart. For example, if you are interested in this time frame. And we analyze at least 3 screens. First, the largest time frame serves us as an analytical source or source of clues, important observations, source of scenarios, source of insights for viewing the bigger picture. The second time frame is intermediate time frame, where we capture pullback, or we are deciding whether market is going now in a phase of a swing, of an active swing, so we want to be in the swing or wait for a pullback. And the third time frame is for timing our entries. We enter the market, we want to know where to exactly enter our position. So it is the tactical response. The third time frame, the lowest time frame, is for tactical response. And the second one is reference analysis. We're talking about reference analysis in a previous webinar. Well, it is pretty big topic and it cannot be covered in a single webinar. We were talking about extremes, important extremes, starting from monthly highs and lows, and it may be 2 months, 3 months highs and lows, and we have seen how market reacts on these extremes. And we were also talking about relative importance of those reference points for different groups of traders. And we also were talking about commitment of traders who were involved, who are dominating the market, and therefore we were talking about the odds of reversal or consolidation or even continuation. In this webinar we will also pay some attention to this process, but I want now to focus more on multi-screen analysis. And first I want to pay attention to some misconceptions about analyzing larger time frames as well as any smaller time frames. What do traders actually pay attention to in the first place? They start first to monitor trends. They build the trend lines. Even if you use daily chart, even if you use 4-hour chart, which are considered as higher time frames, actually I would say that this information is already outdated. When you build a trend line, it is very good in hindsight. You have seen how this line could have been retested once and you say, okay, I would have entered here. It's very good in hindsight, but in reality it is very difficult to capture such reversal or such pullback, because if you have 2 points already and if you have a trend line built here, it is very, so odds are actually decreasing that market will reverse here at the third time. So the more times price touches this level, actually the more odds that you will see consolidation later on. So the opportunity is gone in this place. And that is the first but not the only misconception. And the second one is very severe, because traders start searching for trends with big days, with the days with the days of big trading range consisting of possibly 200 or 300 pips, or maybe 250 pips or so. They say, okay, so that's a relevant piece of information. Now we see a trend. Now we are looking for a pullback. Now I want to see a pullback. They start building some Fibonacci retracements here, like 38.2%. They try capturing here candlestick formation, and so on and so forth. And not surprisingly, market is not ready to go anywhere. Actually, traders do this all the time, or very frequently, regardless of the time frame they are using. Well, sometimes trending days are important pieces of information, but only in the context of a phase of the market that is good for expecting some swings that will last from, I don't know, 2 to 10 days. Sometimes it's good, but it is actually 10 to 15%. So the odds will be stacked against you if you try to rely on such kind of days. Well, sometimes price action reverses just from the levels located inside of such big days. But actually, it's another story, because traders do not try to capture pullback here. They just follow the price after they see a trending day. So that's the second big misconception about analyzing the market. Now let's talk about relevant information, or at least what I consider as relevant. Well, the first, when you look at the chart, and here you see a weekly chart of Australian dollar versus American dollar. In the previous webinar we were talking about this currency pair. Now I want to start top-down analytical approach using this currency pair. We will also pay attention to other currency pairs as well. But the first question is market trending or balanced? So we want to answer the question about possible state of the market, or is it trending or balanced? Actually, that's not an easy, there's no easy answer here, because when you see, what does it mean that market is trending or balanced? Well, when market is trending, it's not necessarily several black candlesticks in a row or white candlesticks in a row. No, I would say that actually market is balanced when it is located or locked inside of a trading range between important extremes, between intermediate term low and intermediate term high. It may be called long-term high and long-term low. So if it's locked inside of this trading range, at least for the moment, market is balanced. It doesn't mean that it will not break out from this range, but it is balanced. What does it mean that the market is trending? Well, I would say that the market is trending when it has already broken pretty elongated period of consolidation. Remember that we're talking about weekly charts, so I'm showing you a large piece of information here, and I want to start with the chart from American dollar versus Mexican peso that I was showing you so far in the previous webinar. It is weekly chart. So first of all, we want to know whether market is trending or balanced. Well, market can be trending, but the trend can be young, it can be mature, and it can be outdated. For example, if we talk about previous large area of consolidation, actually it was very long-lasting area of consolidation. It was broken out in November 2014, and market has rallied higher, and we again see another area of consolidation here. If you want to measure distance between two areas of consolidation, let's mark the first one with number 1, the second one with number 2. If you want to measure distance between number 1 and number 2, you see that they are not overlapping, so you can possibly you can clearly see here that there is absolutely no overlap here, so they are sort of standing on pretty good distance from each other. It means that imbalance of the market is significant, so that's a very good indication of trending market. And consolidation number 3. You may notice again that market is unable to repair the structure, or in other words, to get back to their previous trading range, the trading range number 2. So we treat this market as a trading market, as a trading phase, as a very active trading phase. Then market starts to move in with increased volatility. With increased volatility, you may notice that even if you draw a trend line here, I never mean that you can buy on this trend line. No, if you draw a trend line here, you may see that market starts to accelerate, and you see 45 degrees angle. It's area of culmination. So you see that market gets already back into the third trading range. It's getting back into the third trading range, and I would say that this trend is becoming mature. Market is trending, so it remains to be trending, but the trend actually enters the outdated, possibly outdated phase. So in other words, market is experiencing difficulties in breaking its recent highs. It's more easy possibly to work in the direction of this trend, but the pullbacks are more significant, and actually your trades should be more short-term in comparison to previous rallies that allowed you to just be in position, just hold this position. So now your approach should be more short-term. So you see that we have overlap. Consolidation number 3 and consolidation number 4 overlap each other. So trend enters the mature phase or outdated phase. So will it lead to reversal? Well, not necessarily. Well, trends have very strong inertia, so they move in a very long-term manner. So it's very difficult to see a reversal. They instead test the highs many times. They consolidate on the tops. So actually it's very difficult to catch a top here. Well, you don't need to catch tops if you want to make successful trades. All we want to do here, we want just to possibly identify the phase of the trend. So we are now trading in the major market on Mexican peso. Well, what about the euro? What about euro? For the euro, the situation looks very balanced, because market was not moving at all, starting from actually March 2015. It was not moving at all. Market has established long-term high, long-term low, intermediate-term high, intermediate-term low. Now it's not moving anywhere. But I would say that if market breaks this area of consolidation, it can move very quickly in a very rapid manner. So we can see actually the big rally. Well, I would expect breakout to the downside for euro. If you take a look at British pound, for example, let's take a look at British pound just a minute. If you take a look at British pound, you see that I'm having short trade right here from the level 1.38 or so. It's a short trade, and you see that I'm going to take my profits near previous extreme. So I'm not heading for a very big move. So I'm working from inside of the range to the borders of this range. So my perspective is pretty short term. Well, it's a trending market, yes, and I'm holding this for a second week already. I'm holding this short for a second week, but well, I'm not expecting very big trend. Well, it might happen, but I want to manage risks as a trader. I don't want to predict. What I want to say here for the British pound was consolidating in a very long-term trading range, or a very long-term consolidation until 2016, until January of 2016. So you see that now market is trading outside of this large consolidation. So I would say that British pound is trending, and it is pretty clearly that it is a young trend. It is a young trend, okay? So because you see that these two small areas of consolidation don't overlap. They absolutely don't overlap, and it is easily explainable because market was trading in very long-term trading range for so long period of time that it is absolutely essential to see a large swing. Well, it may also be, it may also be, we may also see pullbacks. Market will not necessarily go one candlestick after another. Well, it might happen. I don't exclude this scenario, but actually I'm a short-term trader, so I'm not holding positions for such large period of time. Well, but we see here no overlaps. That's a first very important piece of information. So we know that British pound have weakness in comparison to euro. That's why we can play this weakness using, guess what? Using euro versus British pound. So this market looks also very interesting. Also very interesting because we have here two areas of consolidation separated by two weekly candlesticks. We see that these areas of consolidation don't overlap each other, so this market looks also very bullish. Well, but if we take a look at the larger perspective, we see that market is trading within large trading range. And as market is going higher, we see that we have a pretty clear perspective of its target. It's possibly 0.95, so market is about to reach the higher side of this trading range. So in comparison to British pound, where it is trading on long-term lows, and nobody sees what's happening below, nobody knows what levels are located below. If you can compare it to the euro versus British pound, you clearly see possible area of resistance. It doesn't mean that it will reverse on this area of resistance, but you clearly see this area of resistance. Now let's look at daily chart, which is considered as a smaller time frame than the weekly chart. I actually use daily charts all the time. I have a second monitor where I watch this daily chart regardless of the time frame using for my trading. Well, my working time frame is 30-minute chart. I combine it with a daily chart. I start my analysis with a weekly chart, but I not watch weekly chart all the time. But I watch daily chart all the time because it's important for me to have this perspective before my eyes. And the second thing, so we already know that there are no overlaps. Structure is not being repaired here. We have no overlaps. It is a sign of trending market. I would say even it is a sign of young trending market. What do we have? What else do we have here? Secondly, when I watch the chart, I want to know whether there are elongations and right-handed skewings. What do I mean by that? By elongation, I mean trading range or consolidation area, whatever it can be. It can be flag, it can be pennant, it can be whatever formation, whatever chart pattern. But if we had a nice rally before this trading range, I would say this is elongation. So the more elongated this trading range is, the more odds of breakout to the direction of the previous trend we have. Not necessarily it is, or not always it is so, but the odds will be greater that we will see breakout in the direction of a previous trend. Well, the explanation is very simple. Market is being supported here, so market is holding higher prices. Remember that analyzing the market, we want not just to see what is happening on the price. We see the relationship between price and value. And the parameter that is now less important than price is time. The more time price spends on certain price levels, the more market validates those levels. In other words, it accepts those levels. Market stands near these levels. Market stands near this area, and this area is being validated. In other words, there is no need to leave this area. There is no need to generate a rally to the downside. Market can actually generate price action to the upside instead, because it's a very good tradable area. Value is located already in in this consolidation. Price is moving higher, value also moves higher and keeps at the chosen level. That's why when I'm looking at British pound right here, I see that I have elongation here. So I see that trading range is pretty elongated. It had started building in June 24th, which was actually, it was not. This is June 24th. It is Brexit. It is Brexit, right? And markets started to consolidate just after the Brexit. So markets were scared. Nobody were going to speculate here. No traders were actually involved in the British pound. But later on, we have seen that British pound possibly is driven down by the sellers, by the supply. So if I see elongation, another week, and another month of consolidation shows me that the odds of continuation of previous trend are increasing. So if I'm going to establish a short position here, I would be more right than wrong. I would be right in more cases. That's why I'm trading in the short side here. Level 1.38 actually is a level. It's a rotational center that I was using for building my short position here, and my destination was short, actually, not long, because I know pretty clearly that after we have elongation here, market is going to break to the downside. That's the second observation. Very important observation. And also, price action consists of nuances. What if we had seen the breakout of this reference point? I would say that this structure would be broken. In other words, we would have seen that trading range has become more wide, more volatile actually, and it would not be good for the trending scenario. If you have such volatile price action, well, anything can happen actually, and market can resume going to the previous direction, in direction of a trend. But more actually, often than not, we see that market tries to widen this trading range one more time, if not generates some more meaningful move to the upside. Well, that's an example how market was behaving in the first 2 quarters of 2016. Actually, we have seen that the previous reference point from March was broken out sorry, it was not March, it was February, and it was broken out in March. So this reference point was taken here. Okay, so market has broken this structure. The situation would have become more predictable if the market would not have broken this reference point, if we have seen elongation. So in this case, market would predictably go down after the Brexit, or even before the Brexit, because value would concentrate very heavily, would concentrate near those levels, but not at this time, not at that time. So that's why we have such choppiness. We have choppy market action, and actually it was very hard to establish short position before the Brexit and after the Brexit as well. But very different situation is now on the British pound. You see that trading range is narrowing, showing sort of a triangle here. It is a very good sign for continuation. The good sign that market will continue moving to the downside. Okay, let's once again repeat. The first question is whether market is trending or balanced. If market is balanced, we would see that it is located inside, or it is locked inside intermediate term highs and intermediate term lows. It's not going anywhere. It shows us very short-term setups, then generates some local rallies that are not very elongated here. So market moves just within this trading range. If market is trending, we can see that it has broken out from areas of pretty long-term consolidations. Well, this is trending market. Again, if you can see that there is no overlap between two trading ranges, number 1 and number 2, there's no overlap. If you have a space between them, it is another sign of a nice or young trading market. Again, if you see that good price action, good trading activity is followed by the large consolidation, by the elongation with decrease in volatility, it is also the sign that it will possibly be broken out to the downside. It is elongation, right? It is elongation. We see value, we see price, and we see that value is concentrated within a very limited price range. And the third important question is, where are major support and resistance areas located? When we talk about support and resistance, we assume that it is not line that it is a support. It is rather an area. If you look at the American dollar versus Japanese yen, you would see that here we see evident resistance area, but we see that there is no line here. Market actually shows us resistance on some large area actually that it is possibly 70-80 pips or so. And another question is whether this is a support or not. Well, market was trending for Japanese yen, and that's why we should not seek for support here, because it is very difficult to catch bottoms, and we don't want to get another low here. It is actually not a support. Well, it is visible, but we are not going counter trend in such case. Well, we want to go with the trend. So the major resistance area is here, the major support area was here, but it is no longer here. And another source of information is located inside of a trading range. So we don't want just to look what is happening at the bottoms, at the tops of the range. We also want to look inside of a range and see what is happening there. Okay, so if we get back to the previous slide, if we see the chart, and if we pay attention to levels located inside of a trading range, first we may see that there are several levels touched by the price several times, and we have to choose what level is more relevant for our goals, for the sake of building positions near this level. And here comes the third time frame into play, because this is a daily chart, and to choose appropriate level we have to switch to the lower time frame. Actually, it might be 4-hour or 30-minute chart. Let's switch to 30-minute chart and see what was happening with the British pound. First of all, let's again start with daily chart, and you see that on a daily chart we clearly see that we have some kind of level here. We have some kind of level here, but it is very clearly visible in hindsight. In the heat of the game, it's not so visible actually. That's why I prefer sometimes to watch 30-minute chart. That's my working time frame where I make decisions, where I time my entries, where I place my stops, and so on and so forth. And I want to pay attention to level 1.30, 40 or 38 or 39, it doesn't matter actually. A few pips, they don't. We don't care about few pips, alright. So why do I pay attention to this level? I scroll the chart back and want to see, actually it's 39, okay, it's 39, it's 38, around that numbers. I want to see spots of very low volatility here. I not only want to see pullbacks where the market is testing this level on the daily chart or on a 4-hour chart or on any other chart. We have these tests, but I also want to see spots of low volatility, which are very important clues of information or pieces of information, because they show whether the market is showing us that sometimes we have points of balance right near this level. Market is balanced. It touches this level, it loses volatility, it consolidates, it stands without any meaningful acceleration. So that's why 1.3039 level is important. And again, I see it all the way in August. I see it all the way in August. Not to say that this level was also tested by the price many times, and that's why this level actually is relevant for making trading decisions. And guess how do we use this level? How do we use this level for our trading purposes? It's 30-minute chart, remember. That is a screenshot from one of my trading accounts. I had entered immediately after market has broken out this level to the downside. Actually, not immediately. I would show it to you on the chart. On the second account, which is used for building more long-term positions, I have entered later on, and I had entered here on a pullback. Well, for the very short-term entry, I was using ATR as a reminder that volatility has become the lowest for the period of 2 days, and also I see that market was unable to sustain any meaningful rally to the upside, and it is going down, and I see candlestick, which I call initiative. Sorry about that. I will increase my chart. I call it initiative candlestick or initiative bar that touches or closes right on the level, right on the rotational center. It happens. Guess what is the time for this setup? Actually, this setup occurs actually at first or the second hour of European session opening. So when market starts going to the downside, I know that my area of resistance, at least short-term area of resistance, is built using this initiative bar. I use it the lowest and highest value of the initiative bar, placing my stop 3-4 ticks above the highest value of this initiative bar. So in this case it is 1.3061 or so. And see what happens later on. Market tests this area with rally to the upside, and I know that I never should exit my position before market tests this level. Well, I actually entered the second position a few days after that, after the primary setup, and I know that my stop should be placed here, right above the initiative bar. And you see what happens. Market touches this area, and 2 or 3 ticks. Two or three ticks actually was a distance between the price and my stop. It is very dangerous or aggressive price action, but nevertheless my stop was not taken. It was not captured, and now market is going down, and I'm in pretty good position, which can bring 4 to 5 or 5 to 1 profit loss ratio in this trade. So that's practical aspect of using 30-minute charts. So when we know that the market is trending, we see it from a weekly chart, we switch to the daily chart, we confirm our hypothesis, we search for a level on a 30-minute chart, and then we enter a position. Whatever it can be, whatever setup it can be a momentum trade, it can be pullback trade from a level, or even you can capture a pullback here on Friday, but nevertheless you have several entries here, several opportunities to enter a short trade here. And almost the same situation is on Euro versus British Pound. You see the same level or the same area, but even more importantly than that, here We have ATR, or average to range, is even lower, so it generates new low for the period of 3 days. It is more strong setup than with British pound. So we had an entry here on September 20. The breakout momentum trade here, breaking the level 0.8574. Now let's see how I have built this level. Well, first of all, this level, of course, is located somewhere in the trading, inside of a trading range. It's an important piece of information. Also, we have seen that price sort of was leaning to this level, but we also had other levels located lower. How do we know that 0.8578 is important? And to answer this question, again, I'm switching to 30-minute chart, and I'm scrolling the chart back. I see a couple of actually tests here. That's the first piece of information. I scroll the chart back again. I see again that market tests this area several times. But even more importantly than that is that market is not only testing, or was not only testing this level, but we see that it was consolidating around this level with decreased volatility. So it sort of was standing near this level. Volatility was small. Market was balancing. It is very important clue. It is very important piece of information. Sequence of doji bars. Sequence of doji bars with no movement, with no acceleration. They are building right near this level or along this level. That's why, not surprisingly, when market was breaking out this level during September 20th, the question is where is initiative candlestick or initiative bar here? Well, I don't remember exactly. It was, I guess, not 78. It was 76. But I marked this candlestick as an initiative bar. It was initiative bar here, and the support area was located like it is shown here. Like it is shown here on this slide. If we build average to range indicator again, and we see that, well, market has generated rally during September 23rd without any low on ATR. It has just generated it, and market just goes without any volatility decreasing to its low, and eventually we see that market goes higher and higher here. The weakness of British pound helps this market going up, but also you see that the important level or relevant level is located, sorry I'm not a very good painter, is located here, and some traders place their trailing stops here. They say, okay, we have meaningful action and we have support. They say we have support here, so we have to place our stop here. Their stops are whipsawed. They say, okay, now this is a short signal. They start reversing their trades, but we know that the relevant level, the most important level, is located here, and before market breaks this level, bullish scenario is not cancelled. And if we know that, we can survive those pullbacks and be in our position. We can survive pullbacks. It's not comfortable psychologically. It's not absolutely comfortable to see such pullbacks when you're already in a profit. Well, you already have a big profit and you give it almost all back, or 2/3 of this profit back. It is not absolutely comfortable psychologically. But in this case, you might decide to take your profits partially, to take some of your profits on highs when you achieve 3-to-1 profit-loss ratio. But if you want to survive in your position, if you want to keep your position, if you want to have your position going forward, you should forget such thing as psychological comfort. Trading is not about psychological comfort, actually. Trading is about making good decisions, about managing odds, managing probabilities, but it is not about our psychological comfort. And now we are coming to the finish of this webinar. Actually, we are finishing the series of 2 webinars. Well, market analysis is a very big topic, and to analyze market correctly, you have to practice, practice, and practice again. What I want to say is that big picture perspective is important, regardless of what time frame you use. You might use 5-minute chart, 30-minute chart, 15-minute chart, but if you don't use big picture perspective, you just focus on tactical response. You don't have decent expectations about the market. You have tactical response. You don't have a decent reason of going long and going short. Well, you can play break even. Sometimes you can earn profit if you go with the price, but most of the time you're giving all the profits back to the market. And to avoid that, to keep your profits in your pocket, you should combine several time frames together. You should build also logic context for your trades. Thank you for your attention. This webinar was prepared by Stanislav Bernhoff and Exness Company. Have a good trading, trade responsibly, manage risks, and see you in the next videos. Bye bye.